This is Declarations.
At the end of the day, I think what we do, it's a combination of years of experience with just constant hard work and delivery every week. You always learn every week, every day you learn. We apply the entire private equity playbook into the lower middle market in technology, and doing that with a lot of energy, excitement, entrepreneurship, and professionalism, I think makes a difference. You build differentiation every week, and over the years, you start to build a firm that becomes unique because it's very difficult to replicate.
Hi, this is Todd Rich, and welcome to the Declarations podcast. The purpose of this podcast is to engage with thought leaders in investing who provide an independent perspective. Our goals are to explore the foundations behind their success, to understand the source of their inspiration, and through these conversations, to become better investors. We hope you enjoy this episode. Today's guest is Francisco Alvarez-Demalde. Francisco is co-founder and managing partner of Riverwood Capital, a leading private equity firm focused on proven high-growth technology and innovation-driven businesses globally. Francisco brings a background in both operations and investing, having started his entrepreneurial journey back in the late 1990s during the first internet wave, and then being part of the first generation of tech LBO investing at KKR. He brings a global perspective into scaling technology companies, shaped by decades of experience partnering with CEOs in the US and other markets. Riverwood has invested in over 85 companies, with average revenue growth of over 35% per year during the past 15 years. Francisco is a passionate advocate for entrepreneurship and private investing in Latin America, including maintaining a deep personal and professional connection to his native Argentina, where I also used to live. I am proud to acknowledge that Francisco's family office has also invested with us at Declaration. Outside of Riverwood, Francisco and his wife Lucila are passionate about education. They founded a tech education program called Digitar. They are both donors to and on the board of trustees of Francisco's alma mater, San Andres University in Buenos Aires, and they support other education-related initiatives. Francisco is an agent of change, and I'm so excited to hear from him today. Francisco, bienvenidos. Welcome to today's podcast.
Thank you, Todd. Excited to be with you. Thanks for inviting me.
Great. Well, as you know, I like to start all of these podcasts the same way, which is to acknowledge the Declaration of Independence. In my view, in the United States, we created that document as a foundation for American society, but it also provides an inspiration or aspiration of our goals. So, Francisco, what is your declaration?
Well, look, I think my declaration is that in life, it's about trying to have a positive impact on others. And that starts with my family, of course, my parents, my wife, my brothers, my kids. And I think my professional career, I take a similar approach. I think a lot about, of course, I want to have my own plans and my ambition towards building, better businesses, towards my own company also being better every time. But I think it's also about the impact that we can have in society. And I know that, Todd, we share a lot of common values and ideas in terms of how private investing can not only be a good business, but also can be a driver of economic growth, of opportunity. So I feel proud about the type of investing that we do and the type of companies that we invest behind, and how that creates opportunity, that creates economic growth, that creates almost like a network effect for a lot of people to have their own journeys and their own ambitions. So that's how I would define probably my declaration.
I think that's great. So basically, it's a positive impact on others, which is such a wonderful theory. And let's touch on that. You mentioned in your professional life, in your personal life, and in your community. So let's touch on each of those in a second. But first, I'd like to start with your upbringing. So I know you grew up in Buenos Aires in Argentina. You went to San Andres, which is one of the best universities in Argentina. Although I'll acknowledge I went to a rival school, La Ditela. But how did that experience shape you?
Yeah, look, I think that when I look at me growing up, it all starts at home, with the family. My grandparents were immigrants. One of them came from Spain, the other part of the family, previous generations from Italy. And then we all grew up in Argentina that has its growth and volatility and history. But then, inside my home, it was all about paying attention to education, to try to do the right thing, to also work hard. I think I got that lesson from my parents in terms of learning from a young age to, the spirit of working hard is not only an obligation, but it's an opportunity for you to kind of pursue happiness and feel accomplished about what you do. I went to public university or public school in high school. That was a great opportunity for me because I connected with a lot of different friends and people from, very different backgrounds. And then when I had to study, I was struggling between going to a larger public university or like this private San Andres University that I was at that time, probably younger as an institution. And I ended up choosing economics there. And it was a great opportunity for me because it kind of gave me access to a new way of thinking, new networks, also a more global connectivity. So that was also helpful for me. So I think my beginnings were at home, really, with this promotion of trying to do the right thing on education. My parents' dream was always for, their kids to access better education than themselves. It's kind of also what I hope for my kids also. And then also they gave me the opportunity at a very young age to really also work. I started working already when I was in high school. I already were doing some internships between high school and university. I worked for a few technology companies back in the late 90s.
Wow.
Very, very young. So I think I learned very quickly, not only that getting a good education is important for me to know a lot about economics or to, learn about finance or learn about other things.
And I guess, one of the things that we have in common, although we took different paths, is that we both in college ended up writing a senior thesis about venture capital in Latin America. Now, you decided to actually follow through with that educational process. It sounds like you worked in technology companies, you studied venture capital, and then you became a technology growth equity investor. I chose a different path. I left Latin American venture capital and did real estate. But tell me, how did your experience of working in a technology company and studying that industry, how did that end up shaping what you ultimately wanted to do with your career?
Having worked at a very young age, regardless of the sector, clearly me getting into tech was important because then when I ended up at KKR in California, not only I was at the right place at the right time, but I also had the knowledge and interest. I wasn't an expert at all. I was very young still back then when I started doing tech investing at KKR. But I had that thing, having worked before in a startup in tech, for the viewers or the listeners that don't know all the history or don't have our age. But, back in 98, 99, internet was everything, a little bit like AI today. Everyone are talking about internet and all these things. Then suddenly in 2001, like tech disappeared and people thought that internet wasn't going to have such a big impact. And, it was kind of a little bit a desert. So I was part of that last part of the internet bubble that gave me that excitement and curiosity about tech. So then when I was back in KKR in 2004 and tech started to come back in relevance, I not only was at the right place at the right time, but I also had that curiosity about tech. So I was like all over trying to focus myself only in tech, which at that time at KKR, I was a generalist. We were doing every sector, every industry. So I think to your point, sometimes things happen that impact you in life and you don't really know how that's going to shape the future. But for me, even though I have no idea that I was going to end up being a tech investor, having done this experience and having the access to tech in 99, then even though then it went into a whole desert and for years, I thought it was a waste of time or like probably it wasn't going to drive my whole future. It ended up then coming back and being pretty relevant for me.
Now, when during that journey did you come to the US and why? What drove you to leave Argentina?
So concurrent with this kind of, let's call it NASA crash or the burst of the internet bubble, I was also finishing my university. So I had to decide what to do because I was working and getting into working in tech as I was also studying in university. And then I thought, okay, what I'm going to do with my life. I had the opportunity to keep being an entrepreneur, but then I was more like, okay, maybe at this age, I was very young, just right out of college or finishing college, discussed it with my parents, my brothers. I said, maybe I should get some experience in a big company. And then I did this exchange program in Philadelphia in UPenn, which was awesome also for me. The reason why I went there is because I met someone that was from Wharton, and I thought, this person is really smart, so I might just rather try to see if I can go there to see if I learn something. And I ended up doing an exchange in UPenn. That's how I learned also more about Wall Street. And I ended up then going to Goldman in New York. So that was kind of my way of really moving to the US. It was more in pursuit of some education, but then at the end, a professional career. And then I moved to New York. I went to Goldman. Then I did the investment banking career. At the same time, also, one of my brothers was doing the same. Another brother also joined investment banking. So it was fun. It was like
Wow.
3 brothers in New York doing the same thing. And then I got this opportunity to move to California and get into private equity.
So Goldman Sachs, Eaton Park, KKR, and that's in some ways a classic private equity career, right? The finance side. I would imagine very few people, though, also had the operating background working at a tech company. So did that give you some sort of a real advantage or a different way of thinking, different way of approaching it?
I think it gave me a little bit of an edge when I was at this first phase of my professional career where and I think a lot for my kids, it's almost like you get access to this education, but then it's really important, in my opinion, to mix that education with just real
life experience.
Yeah, exactly. Working in a restaurant, in a shop, in anything, as a intern in a company. In my case, I was actually a founder of a small company, but so that gave me a lot of experience. But I think it's really important to get to the playfield, because sometimes theory looks very good, but then the building in practice is very different from PowerPoints, from theory, from university. So I got an edge, and most of the edge was I was just a little bit more street savvy than probably other young professionals that were coming from great universities who probably didn't have my experience. It also made me a little bit more, I think, inclined to take some risk. So, for example, Goldman, I love that institution, but then I was, I felt the confidence and the excitement to try something new after that. Same thing when I was at KKR, I love that place. It was a great experience for me. I'm very grateful to that firm. But then when I got the opportunity, I had the conviction and the confidence to then leave and a comfortable place and, really start my own business. So
let's talk about that. I mean, it sounds, even just in describing this, the lead up to starting your own business, it sounds like fundamentally you're an entrepreneur at heart. And so you were willing to take these risks. You felt confident and you believed in yourself. That's clearly not typical. Not everybody who goes to a great firm like Goldman Sachs or KKR then ends up starting their own business. And if I recall, I think you worked with your Riverwood co-founder, Jeff, while at KKR, right?
That's where we met.
Okay, that's where you met. So just tell us what were you thinking? Why start your own firm? What was your aspiration at the time?
Yeah, I would say my entrepreneurial journey is one that, I don't know, I feel proud about it, but it's not one of, shiny objects or kind of grandiloquent plans. I went step by step, and I think as I was building myself and with my colleagues the right foundation, then I took the next step. So I tend to believe it was a story of, slow build-up more than a story of sudden or imminent success, which, sometimes I see journeys that are amazing and they go much faster than mine. And
right. It took you 10 years to become an overnight success. That sort of thing. Right.
Yeah, it's that people get success in a month or something, or whatever people call success. That's a separate conversation we can have, what success means and what is really success. But look, I think what happened is we were there at KKR. We were doing these tech buyouts or LBOs in technology. Technology was becoming clearly for everybody a very important industry that was starting to grow. If you look back at this history we just talked about 5 minutes ago, internet came, it was a big boom. Then there was a burst. Then people thought, oh, that's kind of a waste of time. Then years later, it started to have an impact. And then not only internet connectivity, but then internet connectivity, software, then mobile connectivity, all these became bigger and bigger. And technology was becoming a core part of the economy, which wasn't before. And then as part of that evolution, Jeff and I, that we became very close friends and now co-founders and partners, we realized that technology was going to impact almost every sector in the economy. Then you have firms that were doing big deals like the LBOs, and that was more driven by leverage. I'm going to put leverage in this company and then create a good return. Then we met and became friends with the venture capital community, and we saw all these venture firms kind of doing amazing deals like innovation, startups, new things. But then as the industry was getting bigger, and as we were doing these two very, very different approaches, one side the LBO and another side the venture approach, we said with Jeff, why don't we build a firm that does something in the middle? Where we can invest in companies that are high growth, that will take advantage of all this technology opportunity and this secular growth of technology adoption. But at the same time, and that growth can allow us to create a good performance and good returns and all that without leverage. But at the same time, we don't have to take the venture risk. We are already in established businesses and
true growth private equity, probably at the very beginning of when that was a concept. You are at the forefront of creating that concept.
So back then, I think growth was already a concept in the industry, was more focused on consumer or healthcare or in retail, other type of sectors. But then as technology got bigger, we saw the opportunity to apply this idea of let's create returns driven by growth into the technology industry. And we thought that was very compelling because our investors and ourselves, we're going to have an increasing target market, more and more tech companies, more and more growth opportunity if you are investing behind a software company. But at the same time, we don't have to take a venture risk of a startup. So as more companies get to scale, they have a proven business, they would need a partner like us to really scale. And then when I look now at what I used to think was when I left KKR to do this, I underestimated how difficult it was going to be at the beginning. I was I had all this excitement for the next few years and all that. It was hard work in the first years. But then I also underestimated how big the opportunity was. I think the opportunity now, the first year in business, to give you a sense, Todd, we look at 40 opportunities, and when they're doing 4 deals in our firm in 2024, last year or this year, we're looking at over 1,000 qualified opportunities. So the market, there's so
much bigger,
so much in tech that it's actually bigger than what I thought it would be.
Now, you talked about growth a lot, about helping these companies scale. How do you define growth? Is that a revenue metric? Is that profitability? I guess it depends on the stage that you enter these companies, but let's talk about what you mean by growth.
Yeah, I think, look, the way we do it in our firm, our idea of underwriting is a combination of growth with also what we define as proven or profitable growth. And the two things go together and they're correlated. So we always think that, and if I go deeper into how the growth market has evolved over the years, in particular in the last 5-7 years where you had more capital coming into growth, that second component of focusing on profitable growth, I would say became even a more important differentiator.
Right.
So when you look at the market, the way we think about it is, I'm trying to invest behind 20, 30, 40, 50% growth. My average revenue growth across my companies is 35% when you look at 15 years back. But at the same time, I'm also very focused on investing in companies that already have a business that is sustainable, meaning that it's either profitable, making money, positive EBITDA with good margins, or if it has a negative EBITDA, this business, it's doing it because it's investing for growth, but I can turn the business profitable if we need to. That's what I would define as sustainable. So these companies do not really require another funding round, or you don't have this exposure to cyclicality of capital.
Why do they want your capital? In other words, if they don't need the extra funding round, if they're already profitable, what is it that they are looking?
Yeah, the drivers for our investments in our companies, I would say it varies, but one is sometimes some shareholders want liquidity. Companies are private, so some people want to sell. That can be an early investor, it can be a family member, it can be the founders itself. It can be that the founder retire and then the CEO, there's an opportunity to buy. Sometimes we do that. We just do a secondary. Sometimes it's primary capital into these businesses. A lot of times it's about growth. So even though these companies control their own future, you always can do more. I've been calling that growth engines. You can always create new growth engines for a business. So for example, we have a company that starts only in the US and then we help them expand to Europe or to Asia. And for that, you need some investment or new teams for a certain type of the market. Sometimes we find the expansion of go-to-market, for example, from mid-market to enterprise. And to attack or target enterprise clients, you need a different team. You need probably more marketing investment, etc. Sometimes our capital goes into product expansion. So you have a very nice business with good revenues and a good product, and you're making good margins, but then you want to invest a significant amount into building a second or third product and build a product platform that drives upselling. So we make investments towards that type of expansion. And finally, sometimes we also fund M&A. So, our companies,
Right.
once you reach a certain scale, you reach a certain leadership in your subsector, we are big believers that sometimes, making some accretive acquisitions can be very useful, not only to gain a scale and operating leverage, but then get ubiquity within your sector. You get more strategic. So one thing that we do, if you look back at our history, of the 85 companies we invested, our average revenues at entry are around 40 million. And then, after a few years, they go from 40, 50 to 150 to 100 million of revenue. And part of that growth sometimes is 100% organic. Sometimes it's a combination of organic and M&A. And one thing that happens is once our companies reach more than 70, 80, 100 million, we start to see pretty interesting operating leverage. So that's interesting because it gives you the ability to, run better that ROI internal machine in terms of how much you invest for growth versus how much you keep for profitability.
The way you talk about it, of investing only in companies that are growing on average 35% per year, and it's profitable growth, or you could sustain the profitability by turning it on or off in a sense, that sounds like pretty attractive. Why wouldn't everyone invest in that? I guess it comes down in part to price. And so in the real estate market where I am, prices have changed pretty dramatically post-COVID and really post the interest rate reset. Has the same thing happened in the technology sector? Have you seen valuations on companies change pretty meaningfully from, let's say, 2020 to 21, and then again, since then?
Yes. Then I would say that there's a lot of ways we can talk about this, but I'll try to summarize it. I would say from two different dimensions. I think one is the interest rate cycle and how much people pay for growth. And another one are the specific dynamics of private investing in technology. I could say from a macro perspective, interest rates going to almost zero back in 2021 had a big impact in investing and in tech valuations, because by definition, if interest rates were zero, then the multiple you pay for growth is infinite. So there's a clearly correlation between interest rates and growth. Growth becomes much more expensive, much more interesting in the interest rates are low. The opposite happens when interest rates increase. We're like,
right.
You value this growth and you value more cash flow. So clearly that cycle has been present across our portfolio and across our investing. I think the way we have dealt with it is from the beginning, because we were born during the financial crisis, and we have seen these cycles, from the internet crash to then the 2008 financial crisis and everything, is we told our LPs and we told ourselves, hey, to do this efficiently, our job is to deliver secular growth that compounds over the cycles. And we need to make sure that we can do what we do through the cycles. And how do we do that? Well, first, we need to keep consistency at the way we run as a GP. So we've been consistent on our pace of investing. So we have invested over 40 years, approximately 40 years every fund. That allow us to don't have to time exact with some things like that. We've been consistent on deployment. I think also we've been disciplined on valuation. That's really, really important. I think if you are investing into hyper growth, almost like more venture type binary outcomes, valuation becomes less relevant. But the type of investing that we do, valuation is also very relevant, and making sure that you're disciplined at entry and that you pay for good assets, but you don't overpay. It's very, very relevant. And then three, I think we have been able to understand without having to guess the future, but understanding the evolution and the context, and make sure that we make the right decisions with conviction when you have doubts. So for example, when, things were tricky in the middle of COVID, we kept investing into good technology companies. When then things got very exciting in the public markets in 21 and the multiples were crazy. We never kind of validated completely out of context multiples, or we actually exited
Or you exited.
very nicely. So I think we've been having a long-term view of investing, in particular if you're in alternatives, which is a liquid asset and you have to own things for a long time. It's important. It's always important to go back to history and to think 10 years ahead versus trying to be like a trader in 1 year. I think from a perspective of, and the change that had now happened from a macro perspective is that when I look back 15 years, before, at the beginning, there was less competition, but less companies. Then the number of tech companies you can invest increased a lot in number, but then more capital came into tech. It's natural when there's opportunity, capital shows up. That capital reached a peak in 21 when interest rate went to zero. And then there was a correction back after that, interest rate increased and valuations came down. Then from the perspective of now tech investing in private markets, forget about now the interest rate cycle. I think what happened, the two big trends that we saw is one, specifically within growth equity, the new capital that came in those periods of very low interest rates was not distributed linearly across the entire market. I'm not sure if that also happens in real estate, but the fact that more money wants to invest in tech doesn't mean that every part of the tech market gets the same amount of money on a linear basis. People go to different places depending on what they can access. So what happened is a very significant concentration of capital went to a few high momentum names. So there was a concentration into big rounds and also into names that were visible, that were easier to access. So capital goes when it's easier to access. And we call that, by the way, that phenomenon, we call it venture amplification. Kind of like venture moving to growth and it got amplified.
Yep. The same thing happened in real estate, but not so much in certain individual names as much as sectors, right? So everyone moved into apartments and industrial and out of office. And I think in some ways that's still continuing.
Yeah, there's almost like rotations within the sector and capital goes into places where it's easier to access. Our entry market touches those type of names, but most of our companies are mid-size. They're in the 20, 30, 40 million. They're probably not so famous when we invest. They're great companies, but they're not like
the Mag 7.
Yeah, exactly. So they are not Mag 7. So I think we saw a dynamic where, the entry market became more competitive, but it never went into a place of, in our opinion, exuberance, because there was this constant need for growth and for opportunity and technology digitalization. And a lot of the new capital went into these more, highly concentrated parts of the market. By the way, that part of the market is also the part that adjusted the most when the correction happened.
Right.
And it's also some interesting part of the market. There's some interesting GPs doing that. I don't think that that's a negative part of the market. It's an interesting one. It's just that it's more volatile. It's more driven by capital momentum. It works when the music plays, but then when the music stops, it's a very tough place to be because you depend on capital cyclicality.
Right.
The last point, which I think is relevant, and I think maybe it also happened in real estate. The other thing that happened within these alternatives of tech, one was this creation of kind of venture amplification, and then which, was part of the growth industry in a way, but I stayed into what I call proven growth. The other driver was the asset managers that were buying companies at bigger size. The LBOs became bigger. So more capital went into buyouts. So one thing that happened to me in my business is when I started, my exits were either IPOs or strategics. And then in the last 5-6 years, I've been doing IPOs, strategics, but then I also now sell a lot to sponsors.
Sell to private equity companies.
Yeah, there's a lot of big LBOs and private equity shops that want to do tech and know that technology or software is where you can create a lot of value for return generation.
Your focus is a little different, it sounds like. The word I've heard you use when you talk about Riverwood is to talk about the scalability, right? That's always the business that I think you guys are in. And so I guess what do you mean when you say that Riverwood is in the scalability business? And how do you, are there common methods? Is there a playbook that you can use in order to help these companies grow, as you said, from 40 million to 100 million or more?
Look, at the end of the day, I think what we do, it's a combination of years of experience with like just constant hard work and delivery every week. Sometimes I feel like what we do is special Sometimes I feel like it's not so special. It's just a consequence of effort. And like, we just keep doing and keep improving every week. So I don't think it's so special. And I think it depends on the week, how I feel about it and how special it is. But I think, Todd, the way to summarize it in my mind is we apply the entire private equity playbook into the lower middle market in technology, and doing that with a lot of energy, excitement, entrepreneurship, and professionalism, I think makes a difference. At the end of the day, you build differentiation every week. And over the years, you start to build a firm that becomes unique because it's very difficult to replicate. It takes years and years of access and everything. So we put a lot of attention on origination. We access all these private companies. My target market, I have, just to give you a sense, my senior team is talking to all these companies all the time. We track them. I have a data platform where I can see with a lot of data sources that we onboard every week. I can see all my targets live, how many companies I should be talking to. I follow signals to see when do I need to call them, etc. And today I have a target market of over 20,000 companies that I can be talking to.
Hard to focus on that many.
It's a lot of opportunities, but my coverage of that market is very unique. There's no many other firms that have that access to those type of companies, understand them, know them, can call them, track them, etc. Then it's about underwriting. I talk to all of them, and then when the opportunity arises, we do a lot of work on underwriting, and we really try to look at the entire package, the opportunity, the time, the market, the quality of the team, the product. So we really do what I would define as high quality private equity underwriting. And then as we do the underwriting, one thing that my market allows me to do, which is different if you do bigger companies, in the smaller middle market, you can actually start talking about what you can build together before you do a deal. Once you start discussing with partners, with the founder, with the CEO, that's kind of sometimes how we win the deal, or how we convince them to do a deal. We talk for 2 years about some ideas and things.
It's the real partnership model.
Yeah. So then you say, okay, well, what can we do? Look, you have an amazing business in the US. Let's build a global company. That's one of the things that it triggers people to do something. Or, hey, you are amazing in this sector and you have a great product, but you could be selling 2 more things to this target customer base, and that will give you synergies. It will give you more network effect. So we build that before and during the diligence process. Then we own these assets. We join the boards. We have a playbook with them. We kind of help these management teams. I always say that our team is about augmenting the management team that we invest behind. And then we become active business builders. We help these management teams really try to do more and to become successful. And then it's about the exit. It's very easy to buy a company, but it's much more difficult, that much less people in private equity and technology have sold the company at an IPO. So exits are tough to come by. You have to build them. We had 42 portfolio companies that had an exit or partial exit, so a lot of them. And I think that over the years, we increase our respect towards how do we build a company that then we can increase liquidity for our shares, and then we can give liquidity to us and our LPs. So that's really important. And you have to build that operationally. You have to know where you're going, create options for you. I call it building the exit is one of the things that we do. So it's entire package for private equity. Internally, the way we talk about it is we invest, we build, and then we monetize. Those are the 3 functions. And we train our team and we focus on the 3 parts really to scale and run our business.
Hi, this is Todd Rich. Thank you for listening to the Declarations podcast, where top investors and business leaders share their insights and provide an independent perspective. We hope you're enjoying this episode. If you'd like to learn more about Declaration Partners or listen to more episodes of the Declarations podcast, please visit our website at www.declarationpartners.com. And now back to the episode. Well, in this section in the middle that we build, that's really where I think of you guys. I think of you guys as building with scalability. And you've talked a lot about partnering with management teams. Some people I've heard say that the key to growing a tech business, or maybe even any business, rests with a strong founder or a strong CEO. In our conversations, I think you've expressed a slightly more nuanced view, right? That I think you've sort of said that, sure, a strong CEO is important, but it has to be a mix of both entrepreneurship and teamwork, right? What do you mean when you say that? And what is it that you look for when finding these great management teams?
It's a balancing act. This is a big debate today. People talk about the digitalization of our society and social networks, and we're going through this dynamic where like you're either a very big personality and it's everything about you, or
You have a personal brand, right?
yeah, or you don't exist. I think the answer is always a mix of things. I think it depends on the company. We usually do not focus on the part of the market that is this, overnight success, huge hyper growth companies that usually correlate with having a very strong brand on the individual. I think that kind of business requires that type of branding and hyper scaling. Nothing wrong with that part of the market. I think some of those companies probably are not sustainable companies, but a lot of them are amazing and they end up being an incredible part of the economy. I think our type of investing is more about exactly what you described. I think it's having a very strong management teams. We are big believers that leadership is really important. Having an amazing CEO, an amazing founder is fundamental to the success of a company. I can make a huge difference. But, I always also tell our founders and our CEOs, that tell myself that it's not just about one person. It's actually about the team, what you can build, how do you scale beyond yourself? And that requires having a group of entrepreneurs surrounding you and being able to convince them to work as hard as you work and to build the company. We think that creates more sustainable growth for the type of companies that we focus. And then finally, one of the things I think a lot when I look at a founder and I look at the team, beyond the founder, the management team, I always think about having two components that are, to me, sometimes they look contradictory, but they can go together. And when they go together is when magic happens. One is you do have to have an incredible ambition. You have to believe in something bigger than just the plan or yourself or the numbers. Like you gotta have companies that really make a difference. They have a culture that they are trying to build something bigger than themselves and that the financial performance of a company. So that's to me the vision, what we're trying to do, really trying to change to have an impact beyond the numbers. At the same time, you need to mix that ambition and that, view with what I would define as a, tactical execution, like an obsession to get better, to measure what you do. Sometimes people can do both. Sometimes it's a mix. Some people are more on the, growth ambition side. Other people are more on the execution side.
You and I have mentioned this before. Even actually, when you talk about your own business, when you talked about Riverwood, about being the first couple of years were really, really hard. And then you ultimately sort of made it to a point of stability. I don't hear you say, and we've made it and we're done. What I hear you say is that you're still working, and that's what you're looking for from these entrepreneurs. Have a vision, but then keep growing. And I think this is a phrase from you. I think you said, the moment you think you've made it is the moment you start losing. And so it sounds like it's not just the vision or the hard work. It's also a healthy fear that you need to keep on pushing, to keep bettering yourself.
For sure. I tell that to all my colleagues in my firm all the time. I think it's true in investing in almost every sector, because to your point, you mentioned, I'm curious to how you see it in real estate, but money is a commodity, and if there is an opportunity, money always shows up at some point for those opportunities. So you got to build a way to differentiate yourself, and that differentiation is not static. Everybody's all the time raising and improving. So when I look at my firm today, I'm not thinking about the last 15 years. I'm thinking about the next 15. What do I need to do to win? What do I need to have a better offering?
Yep.
Clearly, my competitors got better. In some places, we were really early to the market. We were pioneers in some parts of the market. But to me, that kind of gives an advantage that is short-term if you don't continuously improve. So I'm a huge believer that you got to push yourself. And by the way, that's one of the big, when I look back to also CEOs that have been great CEOs for a long time, I think they have a mental ability to always inject new energy, to never stay with inertia.
Well, one of the things that I see from you guys, right, and it's a differentiator, is that your strategy has not been just to invest in middle market technology companies, which, by the way, that may have already been a differentiator, but then you decided to invest across geographies. It's a global business. You've even done that in Latin America, which is not an area that is known for a lot of successful growth, or nobody very few people, I think of Latin America as a hugely successful private equity sector. And yet you've done it. And maybe it's because you push yourself and you push your companies to do something different. but maybe I'll just ask, how have you done it? To what do you attribute the success?
I mean, the tech opportunity is a global opportunity. The different technology adoption trends that you see, that we all see here in the US, you see it in different forms in Asia, in Europe, in Latin America, everywhere. So I think our opportunity, we always had a clear idea that this was a global opportunity. Even my US company, sometimes I talk to my LPs about this. It's tough to know where a company is from in technology, because you have revenues everywhere. You have clients from different places. You have people in a lot of different places. We have engineers in New York, in Austin, in Romania, in Argentina.
Yep.
So I think it's a technology economy is very global. So at first. Second, I think, why did we also consider Latin American emerging markets in addition to the US as part of our strategy, is because, I had some experience, also a very good network at the beginning. We gave us the confidence to start. And as we started doing it, we realized that at the end, the opportunity was there for us to really help the same way we help a management team in New York or in Menlo Park to apply a similar model in Sao Paulo or in Buenos Aires, with the idea of serving the local markets. But in a lot of cases, some of these companies became companies that are serving actually US clients or European clients. So, as talent access more of technology and technology globalized itself and knowledge got more global, we saw that the opportunity was becoming global from a location perspective. So that's kind of what took us to invest outside of the US. I would say that the thing of why it worked, when we look at the company, let's say in Brazil, and we compare it to a company in the US, we measure it that we underwrite it with the same bar. I think about what is the real market opportunity for this company. If the market opportunity is smaller, I can pay less. If it is bigger, I can pay more.
Right.
The other thing I think about it as a completely different box, where I have to think about it differently. I think we put it in the same bar, but at the same time, we account for the local nuances, from the different dynamics on effects, which is a very big risk when you invest outside the US. We want dollars, we invest in dollars. Yeah. So if you take FX risk, you have to account that in your models. For example, from day one, we always accounted in our models, if a business has FX revenue or revenue in a non-US dollar currency, we always include the valuations into our models to account for that risk of the operation. So that underwriting allow us to really, I think, compare. I can invest.
But particularly difficult to get that right.
It's difficult that we keep learning, but I think we did it from the beginning. We never felt the obligation to invest, in emerging market. We always said, okay, if these are good deals, we'll do them, but I'll compare at the same bar that I'm comparing to a deal in New York or in Menlo Park or wherever the company is. So that's one thing that is really important. A second thing that really helps us in emerging markets or in Latin America is the type of investing we do. If you look at private equity in Latin America, let's say, as an emerging market, the risk that you have that is different from the US is you have a little bit more macro volatility.
Yes.
So that can drive more variability on growth, on elite or margins, because you have more macro dynamics.
Yep, or valuations.
Or valuations, exactly. Capital cyclicality. A second thing is about effects, which is really relevant. On macro volatility, for my business, if you think about my underwriting, I'm doing sustainable companies, mid-size, high growth. I am more isolated from the capital volatility than venture. Venture requires money after you.
Yep.
If you have more capital volatility in Latin America, but if you have a sustainable company, I'm always okay. I'm always growing. I'm always sustainable. So I don't suffer from this capital volatility that you have in Latin America if you're doing venture. So I have a little bit of a more, protected type of company than the venture type companies. And then when I look at LBOs, if you want to do an LBO in Latin America, but your growth is single digit, then you are really exposed to a macro recession, because recessions can hurt your growth. If you are in a supermarket or an industrial company and you have a very significant, bad year, then your growth comes down, then you have leverage. So you have a mix of problems. In my type of companies, growing 30, 40%, the reality is my growth is driven by tech adoption. So it's more uncorrelated with the macro risk. So in a way, part of why I think up to now, I say up to now because, we got to keep working hard, but up to now it works for us, is because I think we do a good job. But at the same time, I think we're in a type of asset that still compounds through this macro volatility and capital cyclicality that you might see. When I look at the US, by the way, some of these learnings from this, let's call it how to deal with macro volatility and how to deal with capital cyclicality can also be applied to the US. In my type of companies, if there is a recession in the US or if there is a significant capital contraction as it happened in 22 and 23, the interest is going up, if my companies are sustainable, we're riding this 20, 30% growth, I can navigate through that cycle very well. So I think it works in both places. Latam is much more pronounced.
Well, so let's focus now for a second on your native Argentina. As you know, I lived there as well. I lived there in 2001 when Argentina was one of the times they had a big political crisis and economic crisis. It seems that more recently, Argentina has, some would say, turned the corner, right? After the election of Javier Milei, Argentina was actually the best performing stock market in the world in 2024. So in your view, has Argentina turned the corner economically?
I think, look, I spend my time in tech, but of course I have my heart with Argentina. I'm not following the weekly macro dynamics. What I can tell you is the following, the way I see it. First of all, the country has, in my opinion, great talent, has a great educational system, years of different dynamics, a combination of education with immigration, a bunch of things that created a good pool of talent. Actually, a lot of our companies, even US companies, we have engineers that are great engineers in Argentina, as in other countries also in Latam. Second, the country has very significant natural resources from all types, from oil to mining to great
agriculture,
fishing. There's everything to win. The country got into a low history of excess spending by the government, running deficits every single year forever, thinking that deficits didn't matter. But deficits at the end, they do matter and they catch up with you, in particular if your currency starts to lose value to an alternative. In the case of Argentina, the alternative is the dollar. But that created this negative spiral where you had deficits, money printing, people go to the dollar, then the currency didn't have value. So therefore, you had constant inflation, and that really harmed economic growth and opportunity for the country. This government has attacked that problem from day one, driving a very aggressive fiscal discipline type plan where they cut the deficit, they actually went into the opposite. And that has brought down inflation, not only current inflation, but inflation expectations. And that also has helped stabilize the effects on the monetary side. Also, when you look at the valuation evolution of the currency has done pretty well compared to other currencies. So I think step one, I would say, was accomplished. But now you need, of course, much more. You need that to get, in a way, confirmed for the long term in terms of running the country with a surplus, because Argentina has a history of defaults, has a history of a lot of deficit. So 1 year is not enough, or 1 year and a half. People have to believe, economic actors, in my opinion, have to believe that this is going to be sustainable for the next 10 years.
Sure.
By the way, the sooner actors believe that, the sooner things are going to happen. You can bring forward all those benefits of credibility.
Right.
Because the country doesn't have a lot of debt to GDP compared to other countries. So it's all a question of people doing their math of, okay, deficit, can they pay the debt or not? So today, the country risk of Argentina is relatively high compared to its own leverage. But because of lack of credibility, the cost of debt continues to be high. So I think it's a question of expectations of the market. And then I tend to believe that, so where we are, I think we are in step one. Can the country get to step two, step three? I think so. I think it will depend on really politics. It will depend on Congress. It will depend on a lot of things. On can this government keep doing this change while, society really adopting this focus? The biggest change of what this government has done, or what Argentina experienced in the last year versus the attempt that I'm sure you also followed, Todd, back 6-7 years ago when Macri won and tried to do something similar, is that this has been talked about directly in the campaign as an objective, of, hey, I'm going to run a fiscal surplus. And the previous, Macri wasn't running based on that. He was running based on vision and ideas and things and good things, but not talking about the deficit. I think in this case, this government really ran the campaign on, I'm going to cut the deficit. They even the candidate Millet was with the, I don't know if you saw it, but like, with like all these type of signs of cutting
Yeah,
expenses
I know with the chainsaw.
with the chainsaw, exactly, with all these things. So I think
That's a little more effective than Ross Perot with his deficit charts, although the same point, I think.
in the Ross Perot, probably more adjusted to the current realities of social networks and Instagram. So now the question is, there's elections coming now in the next 2 months for Congress. These are the midterms. I think that's going to be a big test. Is society going to vote for a continued fiscal surplus and recovery of the basic metrics of macro stability? And I think if that happens, we can move to chapter 2. I think the next chapters are about probably more micro issues, which is you not only need for the country to really enter into very high growth and recover a lot of the growth that was lost over the years. Argentina, if all the variables play the right way, I think it has a very big opportunity to grow at very high rates, 5-8% of GDP. But you need everything to work. And I think it's not just the stability on effects and stability on inflation, which again, good progress, not still fully stabilized. But then you need the next chapter, which is, a better environment for business creation. That means better labor laws, less regulation, a lot of things that the private sector need to really invest. But I think if those things happen, if we move to chapter 2, I'm optimistic. So
let's hope so. Now let's switch from Riverwood and maybe to a little bit more personal. So due to your success at Riverwood, you now have a family office. We're proud your family office, your investment with us at Declaration in our real estate business. But I'd like to just ask for a second, what are you trying to achieve with your family office, and how is that perhaps different from what you're doing at Riverwood?
Yeah, my net worth is the very significant majority is tied to Riverwood itself. And I would say that my mind is even more so. It's more than 100%. It's focused on Riverwood. I love what I do, and I take it with a lot of enthusiasm and responsibility. So I think one thing that I realized is that as, Jeff and I were more successful economically over the years, and as we also had the opportunity to do many more things, at the beginning, I was doing some of them individually and personally, and it was distracting a little bit of my mind. And I'm a big believer that as a leader, you got to focus. You got to just know exactly what you need to do every day. Keep your list short, but impactful. So then we developed this effort more as a way for us to be able to do some of those things without me having to really defocus on my day-to-day, which is Riverwood. So that was really the source. It's not something that I feel it's magic or, unique, but it's something that, we try to do with professionalism and with the objective of trying to invest across different assets, find great managers where we can compound over the long term for us. But at the same time, it doesn't require me to really lose my focus of my day to day.
Makes sense. But you're not just focused on your business. I think it's fair to say that you and your family have also been quite philanthropic. You've been a passionate advocate for education and for entrepreneurship, really, in Latin America. I think you were involved with what they call LAVCA, which is the Latin American Venture Capital Association. You donated the AI research lab at San Andres, your alma mater. What are you trying to achieve philanthropically?
Yeah, look, I think the two things that drive me, again, that I believe personally that can have a positive impact. One is, my view is it's all about education. I'm a big believer that any person can succeed if that person has the right access to opportunity and the right basic of education. And sometimes education is about not just acquiring some knowledge, but it's about building your self-confidence to really go for it, to have the right data points and skills, and to find their way where they can be productive. And then for them to also show that they care and that they can really work hard to achieve it. So that's one area where I believe that, people have an impact. We can have an impact with Lucila, and we do that. I think the second one, which is related to private markets in Latin America in particular, I think that when I look at the region, Latin America, historically, it's a region that is known for natural resources, for agriculture, for energy, for a lot of these things. And when I look at the future, I think that part is great, but you need to complement that with access to talent, but also access to private investing. And the private sector can be a big driver of economic growth. I think a lot of these energy projects or infrastructure projects, there's a lot of government involvement, and that's fine, depending on the country, how much that is. But then in order to have a drive opportunity to create more access to people, for people to really, build a big middle class, you need to have much more than just big government projects. You need to have a driving private sector. And I'm a big believer that private capital, drives amazing growth. So I think anything we can do to promote private equity into these developing economies, I think it's a good thing. Sometimes people say, oh, private equity, they're kind of more, there's some negative connotation, but I actually feel the opposite. I think if you're bringing professional firms that bring experience, access, and they put money into these countries for companies to grow, or even some families to sell, and then if the families sell, then they use the money for something else. That's for sure a positive economic impact into this country. So I think the two things are things that I believe are good for society. They're good for what I care about. So, I try to add my 2 cents to both of them.
Well, look, this conversation is wrapping up right where we started, which is to say that your goal is to have a positive impact on others. And I've seen the way you talk about it with your business, where you're trying to help these companies achieve scalability and to grow. You're trying to do it with your philanthropy. You're trying to do it in your own native country. I know with your children as well. You and Lucila are focused on that. It all comes full circle. So that's great. Now, Francisco, it comes time in this conversation where we go to the standard closing questions. So this is sort of more rapid fire.
Okay.
What is a book that most influenced your thinking or your personal development?
There's a lot of them. I will pick you one that I read recently and I sent to my CEOs, which is Amp It Up by Frank Slutman, which is a very simple book, but it's about the power of intensity. If you're going to get things done, it's sort of about having a plan and execution.
The best advice that you received from your parents or that you give to your own kids?
I will share with you 2 of them if I can. One is something I told my kids last year in a big event that was important for me. I was getting an award, and then I said to them, there's nothing more rewarding in life that what you can achieve for yourself versus what people give you. So don't focus too much on trying to get things from others, but focus more on what can you do for yourself and what can you achieve for yourself.
Right.
So that's one thing that I tell them, and I repeat the same concept in different forms for them to see that it's not about trying to get, it's more about building and getting in exchange of what you do. And so when it's about more like keeping yourself grounded. So I think one thing that I like saying is don't celebrate too much your successes, but then also don't get too depressed when you think you failed. The answer is a little bit in the middle and keep going forward. And I use a lot of the phrase of keep building. And I try to do that in my life. Whenever I have a win, of course I celebrate it, but I don't go crazy. But a lot of times I have made a mistake or something goes wrong or not as I expect. I try to really don't get too depressed. So
that's good. But did you go a little bit crazy when Argentina won the World Cup?
That for sure. But that's an exception.
Okay. Last question. The U.S. Declaration of Independence talks about freedom for life, liberty, and the pursuit of happiness. So Francisco, what do you do in pursuit of happiness?
Look, the pursuit of happiness is a constant exercise. So I think what I do is I try to have a good time in what I do every day at my job. I think I also care a lot about my family and my relatives. So that's something that also motivates me and makes me happy whenever I see them happy and I see them accomplishing their goals. So I think it's the simple things in life. I gotta say, I don't have any magic formula, but it's more to keep yourself grounded, try to win every day, in slight steps. I think that gives you at the end of the day, when you look at the long term, if you have small wins every day, you end up having big wins over the long term.
It's fantastic. Well, thank you, Francisco. Gracias, pibe. This was super, super fun, informative. I think it's really clear that you are having a positive impact in all the things that you do, and I appreciate you sharing it with our audience today.
Thank you, Todd. I appreciate it.
Thank you.
This podcast is provided for discussion and informational purposes only, for use by Declaration Partners, LP, together with its affiliates, referred to as Declaration. The information discussed in this podcast may change at any time without notice, and there is no duty by Declaration to update any person to whom this information is provided. This podcast does not constitute an offer to sell or the solicitation of an offer to purchase any investment product or any interest in the fund or any other investment vehicles or accounts managed or advised by Declaration, a Declaration investment product, in any jurisdiction to any person. Any such offer or solicitation for interest in any Declaration investment product will only be made pursuant to such Declaration investment product's definitive offering documents, which contain a description of the material terms, including risk factors, conflicts of interest, fees and charges, and regulatory and tax considerations relating to such Declaration investment product, and which should be reviewed carefully by potential investors prior to making an investment decision. This podcast does not constitute tax or legal advice. The listener is urged to consult a professional tax and/or legal advisors regarding the possible tax, legal, economic, regulatory, or other risks and consequences associated with any investment, and must be able to bear the risks involved. This podcast may contain certain forward-looking statements which constitute Declaration's views with respect to future events, which can be identified by the use of forward-looking terminology such as intend, seek, expect, target, project, or endeavor. These statements are made based upon such views as they exist as of the date herein. There is no assurance that such views are correct or will prove, with the passage of time, to be correct. Actual events or results may differ materially from those contemplated by such forward-looking statements as a result of factors beyond Declaration's control, including, without limitation, any disruptions in global, regional, or local financial, credit, or real estate markets, acts of God, fire, hurricanes, tropical storms, floods, earthquakes, or other natural disasters, outbreaks of an infectious disease, pandemic, or any other serious public health concern, war, terrorism, labor strikes, electricity shortages, or other national or local emergencies, or any combination of the foregoing. David M. Rubenstein is an anchor investor in Declaration Partners Real Estate Fund II and is not an employee of Declaration. Neither the U.S. Securities and Exchange Commission nor the Securities Regulatory Authority of any state or other jurisdiction has passed upon the accuracy or adequacy of this podcast. No compensation has been awarded to any speaker for statements made that are either testimonials or endorsements. However, certain speakers may be current or former investors in certain Declaration investment products and may receive reduced fees, priority terms, priority access, co-investment rates, among other preferential treatment, which may pose a conflict of interest. Certain speakers may also be affiliates and/or service providers that receive compensation from Declaration for services provided in their service provider capacity, but have not been compensated specifically for any testimonials or endorsements made herein. All statements made on the podcast are the opinions and beliefs of the speaker and may not necessarily represent the opinions, beliefs, and position of Declaration. Consequently, from the foregoing, no reliance whatsoever should be placed on this podcast, and no decision including any investment decision should be made based on this podcast or on the information contained herein.